AT&T is one of the core companies of America. Why is no one buying it? Welcome back everyone, my name's Paul. Today I've got another stock review for you in the form of AT&T. This company is getting more complicated by the day and the share price is showing it. I own AT&T, so now the earnings report has come out, it's time to review it and see if it's worth buying more. AT&T is a pretty controversial stock if I'm honest. All the millennial dividend investors like me love it, but it's not getting much love from the smart money, and it's kind of obvious why. I will be getting into that later, but first I want to stick to the plan and take you through AT&T how I would reevaluate it. First we've got to look at exactly what it does, which is quite a lot to be honest. If you asked an investor out there right now, they would pretty much say to you, HBO Max, woo woo woo, HBO Max. But if you ask the average American on the street, they'd probably say to you it's the guy that provides their phone service, or the guy that provides their friend with their shitty phone service. And this is a very important thing to remember. AT&T is way more than HBO Max. Just try to keep that in your head all the way through. Just in the same way that because Disney Plus has come out, it doesn't mean Disney is worth more than Netflix. AT&T is made up of a huge pile of different telecom services. I'm surprised that investors aren't considering it to be one of the stay-at-home stocks. Over 60% of AT&T's revenues come from the telecom industry. Some of that is consumer mobile phone contracts, and then the rest is business contracts. You know, like providing broadband internet to offices or homes, that sort of thing. Not only is the telecom section its revenue puller, but it's what AT&T has done for years. This is its bread and butter. They have become very efficient at this, and this is where they make most of their profit. Then they've got a couple of South American companies, and the final 32% is made up of their entertainment wing. This is where you'll hear about Turner and Time Warner and HBO Max. So basically AT&T is a telecoms industry leader that's bought a lot of TV stuff. So let's take a look at some of the numbers. Let's take a look at the quantitative data. Now as a dividend investor, I want to know if this company is coming from a safe and stable position. Part of my goal as a dividend investor is to find safe companies with the opportunity for growth, particularly in their dividends. I generally do lean towards dividend growth, but if I can find some obvious growth prospects, then that's a bit of a bonus. Growth is king, and it has been for 10 years. So if you're a growth investor and you're looking back at AT&T, and you're seeing that for 10 years it's underperformed the S&P 500, you're probably not going to go for it. That view could be short-sighted though. AT&T has continuous revenue growth. This is mostly from its solid telecoms business. If you take a look at the balance sheet, it's always got a lot of cash on hand. This is excellent from my perspective as someone who has a penchant for dividends. And if you're interested in value investing, take a look at that price to cash flow. Its free cash flow has been completely disconnected from its price for about 5 years. I'd say that for a fundamental value investor, AT&T should be a very big consideration. So let's move on to the dividend. I shouldn't really have to talk about this much because it's basically increased its dividend for the past 36 years. And as a dividend growth investor, this is what I want to see. This strategy involves me preferring companies who continuously raise their dividend. I obviously don't follow dividends blindly, but this company has something that I'm looking for. It's no good if a company continuously increases its dividend if it can't pay for it. And that is another beauty of AT&T. Not only is it capable of paying its dividend, it's been increasing its ability to do this over the past 5 years. This is a good indicator that AT&T is very safe, and it's working hard to make it more appealing to dividend investors. When I'm looking for negative things in AT&T's fundamentals, one thing sticks out like a sore thumb. AT&T has a credit card problem. Long-term debt is a real issue. Book value wise it's covered. It could pay all of its debts off tomorrow, no problem. But year on year AT&T's debt is really out of control. It fluctuates all the time. There is a big reason for this, and we'll look at that when we look at the qualities of AT&T. But if I'm looking at AT&T from a solely fundamental level, it's pretty covered. If it just continued to do exactly what it's doing right now, it'll have no problem. It'll be fine. But it does tick a lot of boxes for me fundamentally. Lots of cash, lots of dividend safety, debt. Yeah, debt. So if it's doing so well from a numbers standpoint, Why is no one buying it? There are a number of reasons why you wouldn't invest in AT&T from a qualitative level, and I can give you the top 3. T-Mobile, DirecTV, and Time Warner. These are 3 huge and horrible mistakes that AT&T has made in the last 10 years. First, you've got T-Mobile. AT&T were trying to take over it, and in hindsight, it should have been pretty obvious that it was never going to happen. They pushed and didn't think it through. The regulators didn't like it, and it caused the deal to collapse. As part of that breakup, AT&T had to pay T-Mobile $39 billion. So effectively, as part of the botched deal, they ended up financing a direct competitor, which has got to be business 101. Don't just give money away. Then there's DirecTV. DirecTV was a cable company that AT&T bought for about $67 billion. AT&T bought a cable company. This was 6 years after Netflix started streaming. By 2015, it should have been clear. Online streaming was going to be the next big thing. I think in 2015, even I could have told you that that was a bad idea. And then finally we get to Time Warner, which AT&T bought in 2018. I'm guessing AT&T management were thinking, third time lucky. And it fucking better be. AT&T has decided to finally get into the streaming market with HBO Max. And HBO Max is receiving mixed reviews. HBO Max is definitely a good idea. They've got a lot of backing. It's much better than DirecTV anyway. But it's entering very late into an already saturated market where there's a lot of big companies already dug in. Netflix is like right there in your brain. You can't get it out of your head. If you're thinking of TV, you're watching Netflix, right? When everyone's talking about HBO Max, they're always comparing it side by side with Disney. I think that's a mistake. I think that people are comparing HBO and Disney because they're coming out at the same time. The expectations are that no one's going to move away from Netflix, and everybody's going to choose Disney over HBO. This is because Disney has started at a very low price point. So HBO Max already has a big fight on right out of the gate. I'm just not so sure that Disney is in the same market as HBO. It's basically for children, and the price for a subscription reflects that. Disney owns and creates all of its content, so it can afford to have a lower price. I think HBO should be compared with Netflix. I think we're starting to see some cracks in the Netflix business model. Netflix is losing some of its major titles. This is because companies like Disney, like Comcast, like HBO are all taking their titles back for their own streaming services. And Netflix has had to start relying on its own originals, which people are saying aren't very good. It's raising its prices year on year now to compensate for this. And it's annoying customers. I know it's annoying me. And this is my guess at the cause of the latest poor earnings report from Netflix. I feel like Warner should benefit in the same way that Disney does. It owns a lot of its own, well-established content that it can smash onto its shiny new platform. I actually doubled my position in AT&T about a week before the earnings report, and it has not paid off. During the earnings call, AT&T announced that HBO Max had 4 million new subscribers in 3 months. 4 million! That sounds great! Until you realise that Netflix has 192 million subscribers and Disney got to 10 million subscribers in one day. So HBO Max has a chance, but it's gonna be a long game. It's got a lot of teething problems to sort out, and its subscription fee is a little bit high, but nothing Netflix isn't going to catch up to. I'm guessing that it needs that high subscription price to start covering some of that debt. And that is AT&T's biggest issue. All that debt from all those risky, messed up deals. This is a management problem. AT&T is riddled with short-sighted ideas made by out-of-date management. Shareholders have lost confidence in that management. Luckily, AT&T have made a big change at the top, and they very quickly replaced his picture on the website. It looks to me that they're going to use the shutdown as a good excuse to get a new face on the front of the company. And when we emerge from our safety bubbles, all bleary-eyed, we're just going to forget about the past 10 years. I've forgotten about it already. So what's the game plan here? Are AT&T going to tank into the ground? Not likely. Good numbers, potential refresh, and while they're a bit late to the party, Stanky's bringing the beers. But do you remember that all the way back 10 minutes ago, I said that AT&T was much more than HBO Max? AT&T has a 40% share of the US telecom market. That isn't small. It's also balls deep in 5G. This is the area where AT&T knows what it's doing. The core of AT&T's business isn't going anywhere. AT&T has enough cash flow for years more of deals, so at least it's trying to be relevant for the future, right? So what's my takeaway from this reevaluation? Well, I'm still in. The dividend yield is too good, and it adds to a lot of its growth. I think it's an undervalued stock that ticks all the boxes of my investment strategy. I think it might be a good value stock as well, even though it's considerably underperformed the S&P 500 for about 10 years. If you look at the past 5 years, you'll see it's 15% down. This is due to everything we've just spoken about. But the key thing to remember with AT&T is if you reinvest those dividends, you'd actually be up 12%. And over the past 20 years, dividend reinvestment has significantly raised the total return. This is long-term dividend compounding, and this is what I'm looking for in a stock. And this is where I'm at. This is why dividend investors go for AT&T. But don't expect anything to happen anytime soon. This is not going to pay off quickly. We're looking at a lot of long years trading sideways. But I should continue generating wealth through AT&T increasing its dividend. Thanks very much for watching, guys. If you enjoyed this video, please feel free to like, subscribe, and invest.